we take off with earnings galore this week.
Oh man, it was everybody's time. This is another, I think this is important because this is another example of just how pervasive the retail industry is and the impact it has on our global economy, because everyone was talking about the Target earnings today.
Everyone's earnings. Target, Walmart, Home Depot, Kohl's today,
Kohl's,
like
right.
crazy.
Ross, TJX, you name it.
Now nobody's talking about Ross, but yeah, okay.
Well, they're coming out. People might care about those, but anyway. All right. So Target reported a stunning 52% drop in profit for the first quarter, sending the stock tumbling yesterday as much as 27%. Walmart also missed their earnings expectations, and they really got a beating in the news for the first fiscal quarter, as according to CNBC, the retailer felt cost pressure from fuel prices, higher inventory levels, and overstaffing. On the other side of things, Home Depot raised its full year outlook, reported strong quarterly earnings, and posted its strongest first quarter sales ever. Ever. Yes. Mike, let's go to you first. How should we read into these results? What are you thinking about this?
Yeah, I think I actually think, Target, I think, is a strong long-term play. I think they got quite frankly, surprised the market, surprised a lot of people with the short-term results. What I like about Target longer term, and I'll differentiate from Walmart here and Amazon in a moment. At the end of the day, I think Target has been finding the right balance of store and omni and e-commerce. They haven't overbuilt their network. They're finding a sweet spot. I think their pain is more short-term. They got, and surprising to me in the sense that I think they've been a very disciplined operator. But the short-term pain of the payroll and labor hours in their store, and I refer to these as short-term because I believe they will correct their models. They can't correct inflation and wages, but they definitely can correct how they staff stores, how they fill stores. I also think they will make adjustments relative to pricing, merchandise mix, et cetera. Mm-hmm. Look, the storm that's hit us is the consumer during the pandemic had money coming in, whether it was, government supported money or just not spending the same discretionary. They went out and bought big tickets, and they went out and spent a lot of money, and Target was a beneficiary. The Bed Baths were a beneficiary. The consumer now is scaling back, mm-hmm. focusing on smaller purchases, but they're still spending. And that's the story of Home Depot. I mean, the consumer's still holding up.
Mm-hmm. Yeah,
so
that's the interesting part of this.
The consumer, I think, is holding up, but there is a shift from bigger ticket to, still what, necessity or everyday, and I think that's what Home Depot is still playing in. And we work with other retailers that I think are in smaller tickets. They're holding up. There's softness here. Let's not kid ourselves, but are holding up in relative terms. I think Target pivots fine. I think Walmart and Amazon are a little bit different because they've built a lot of infrastructure, bet big on everything's delivered in 15 minutes. And they've got some more structural overhead costs that they'll have to tackle.
Mm-hmm. That's interesting. I might disagree with that somewhat, Mike. This is good to have you on the show. Yeah. So let's see what Dave's got to say first, though.
Yeah, I also kind of disagree, Chris. I don't think this is a short-term blip for Target or Walmart. Frankly, I think if we look at the P&L of a retailer, inflation is hitting every single part of that, and there's no end in sight, right? Like cost of goods, mm-hmm. Their CPG partners are passing along cost inflation to them. I think if we look at indirect costs, they're exploding, and labor is both difficult to find and wage rates are going up. So I think we might be in a new normal for, call it 18 months, where they're just a less profitable model based on the kind of not anything they specifically did, but just market conditions more broadly.
Yeah, I think so too. And I spent all morning reading these earnings reports. And so before I go, what are your take? What's your take here?
I mean, I think more than anything, I'm listening to what Mike's saying about what this means for the reactions from these retailers. Like, what are we going to start to see Walmart and Target do as a result of, and what Dave's saying, what might be planning for the next 18 months of this. And so my hope is that we have retailers like Target, like Walmart, who've been a little slow to the game on moving things like, figuring out faster ways of automation in house, how to work through some of these scenarios that they're still doing manually in store. And that my hope is that we start to see some investment in technology that's going to help try to offset some of these things like labor, like inflation that the team is talking about.
Yeah, interesting points. So here's my take, and then we'll go back to Dave and Mike for kind of the final word here. But my big takeaway from these stories after reading reading the earnings reports today is it's all about inventory. It's actually all about the supply chain snapback that these companies are dealing with. And the reason I say that is you look at the numbers, and Target's, I think, the best example of this. Target said traffic was up 4%. They did a 3% comp, which means their average transaction was down. And so you have to ask yourself, how in a period of inflation is your transaction size down? It makes no sense. And so really what you get back to is they were working through a hell of a lot of markdowns. And I queried some of my friends in the stores at Target, and they said, yeah, we're still clearing through heck loads of inventory. We're still clearing through things from Christmas. And so that puts it in a different perspective here. And Walmart said the same thing. That was the first thing they counted on. Yes, inflation's a factor, but how much of those costs are being passed on to consumers? It sounds like they're still, somewhat buying this growth to some degree. And then most of the issues is in the markdown on the inventory side. The other point I would make, and this is where I disagree with Mike, particularly on Target's outlook. I was looking back at some numbers. I think these are interesting. So Target's market cap in 2017, when we left, was about $32 billion. At the height of the pandemic, which, as we've said with talking about Instacart too, that's as good as it's going to get, right? It's as good as it's going to get for Instacart's business. It's probably as good as it's going to get for Target and Walmart's business, because you had so much money going towards products and versus services. And now that's part of this equation too, is people are snapping back and purchasing more services. Their market cap got up to $130 billion, roughly, give or take, during this period of time. Now it's at 75 billion. So, I sit back and I say to myself, okay, where does this thing settle out? And then I put them in comparison with Walmart, where Walmart's got things like Flipkart, Go Local, Walmart Plus, Ribbit Capital, Walmart Health. They've got some dry powder in the growth keg. Whereas you look at Walmart, where's that growth or improvement in market cap come from?
Target.
Target. Thank you. It's really, they haven't really added many stores. It's all come from pandemic fueled growth or market share grabs as other retailers have gone away because of e-commerce. So it leaves me wondering here, where is the growth story to come for Target here in the future? And that's a big open question for me, quite honestly. And the other point I would make to that is I think people are getting the punchline of the joke, because Target has seen a mass exodus of good retail talent leave the company recently, as we know from following our friends on LinkedIn, which other people might not see. But anyway,
they just got their dividends that were more in the first quarter than they were the whole last year.
Exactly.
Like it's like things like that. Like,
which goes to my point of it's as good as it's going to get. And so anyway, that's long story, but I felt like it was important to cover. But Mike, I'll go back to you, because I kind of disagreed with you, but curious what you think on that take.
Yeah, I think, listen, two things. Not to misrepresent it. I don't think this is a blip. I think this is a more towards, Dave said, an 18-month cycle. Okay. But what I would emphasize here, and I build on what Ann shared. I believe these companies, and where I think they have profit optimization and improvement, is getting back to those basics that she shared. Innovating more in the store, innovating more with categories. I think the one thing I would remind us, I've lived the story of Target being in trouble 20 years ago.
Yeah, right.
Prior to Brian Cornell, everybody's like, they built too many stores. They're not going to be around anymore.
Right.
Or they're going to get wiped out. I wouldn't, Target has, from my vantage point, it's an enduring brand.
Yep.
It's still delivering phenomenal value proposition. And I think it has the wherewithal. I agree with Dave. We got 12 to 18 months of headwind. That's not going to be easy to solve, but I actually think this is a management team that can solve it. And I think that will unlock new growth. And I think that they're also, I think they're still very focused on their core, which I think will be a positive to work as a source as they work through the next 12 to 18 months of headwinds.
Yeah. And I think that makes sense too. And net, what you're saying there is you'd rather be a Walmart or a Target in trying to deal with this than say another retailer that's not on as sturdy of ground, right? That's the key takeaway.